Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 23rd of October. I'm Daniel Lam, your host for the podcast. Finally, we got an important set of Chinese data that beat expectations. In the data released last week, the third quarter GDP expanded by 4.9% year-on-year. That's a beat against a 4.5% expectations. Similarly, industrial production and retail sales surprised to the upside, and the unemployment rate unexpectedly fell to 5% versus consensus estimates at 5.2%. However, after a very quick spurt of excitement immediately following the news release, the price action faded and stocks were put under pressure again. So why was that? Well, this set of data shows that domestic economic conditions are not as bad as what investors think. But there's still contraction in property investment, which is a key area of concern from investors. That deepened to minus 9.1% year-to-date, year-on-year, which is below expectations of a contraction of 8.9%. Residential property sales in the first 9 months of the year also fell by 3.2% year-on-year. Now, the other reason, and perhaps the more important reason, was the good news is bad news mantra. So Chinese policymakers have been implementing gradual and targeted stimulus with the aim of putting a floor under the economy, rather than spurring a significant recovery that would reflate the housing and credit bubbles. Well, the latest set of data actually decreases the probability and the need of a bazooka style of stimulus. In our podcast last Wednesday, we noted that we need to see a return of confidence in Chinese equities, not just from local investors, but from global investors. It seems that the pockets of weakness in the set of data release has not inspired a return of confidence in Chinese assets. It does not raise any urgency for the government to step up on the stimulus. And finally, the uncertainties in the external macro environment, such as the situation in the Middle East, do not help matters. Thus, we continue to be overweight Japan and US equities. We believe in their relatively strong economic performance and idiosyncratic factors, such as the improving corporate governance in Japan and AI-driven revenue growth in the US. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.